Hi everybody. In this video about budgeting, we're going to be specifically talking about the budgeted balance sheet. And we're going to do that through an example. So here we have some information about a balance sheet, specifically budgeting our future balance sheet. And we're going to prepare a balance sheet, a budgeted balance sheet as of March 31st. So keep in mind that a balance sheet is a snapshot in time, a specific day in time. So since we're making a balance sheet as of March 31st, if we're given a balance that's on March 31st, then that would be the number we would use in our budgeted balance sheet. So as you're looking through this information, always keep that in mind as well. All right, so we want to create a T account for both cash and owner's equity for this particular problem. And so I've done that here for us. And I've got my accounting equation, which is also the balance sheet. I've also put in orange or yellow some words out beside each transaction, or not transaction, but information. And that should help us figure out where this information should go. So we're going to go through each one of them and figure out where we should put it, what we should do with it. So the first one is March 31st inventory balance was $15,000. Well, that's telling me a balance. And I know that inventory is on the balance sheet because it's an asset. So I'm not going to put my assets in any particular order. I'm just going to put them where they go. So inventory, they tell me is $15,000. Okay, so A, we're good with. B, March payments for inventory were $4,600. Well, there's a keyword in here, payments for inventory. Well, we already know our inventory balance, but the point of this one is to tell us that we paid $4,600 for some inventory in March. Well, anytime you pay something, cash is going down. So my cash account is decreasing, and we know that cash decreases with credit. So I'm going to put that on the credit side of my cash T account. So we have solved letter B. Letter C, March payments of accounts payable and accrued liabilities are $8,200. So again, we have this keyword, payments. So we paid a total of $8,200. We don't know, and it says we paid them on accounts payable and accrued liabilities, but we don't know what the balances are in those accounts yet. So there's not much we can do with those at this point. So let's keep moving forward. Letter D, March 31st, accounts payable balance was $4,300. Now that's a March 31st balance, so that's the day we're creating this. So we know the balance in our accounts payable account is $4,300, and we know accounts payable is a liability. So I'm just going to put that right in my balance sheet. Accounts payable, $4,300. So letter D, we're good. Letter E tells us that we on February the 28th, furniture and fixtures balance was $34,800. And accumulated depreciation balance was $29,870. Now what we have to remember here is furniture and fixtures, that's an asset, that's depreciable, and its contra asset account, accumulated depreciation, goes wherever it goes. So since it's an asset, the contra asset account, accumulated depreciation, is also under the assets, but it effectively reduces your assets. But what we have to keep in mind is we've got several transactions left down through here. So we may actually purchase some more furniture, we don't know. And we also probably will have a month's worth of depreciation expense that we'll need to increase accumulated depreciation with. So we need to be cognizant that some other things might be happening because this was not a March 31st balance. We have a whole another month that we have to consider there. So I'm going to go ahead and put it in the balance sheet, but being aware that I may have to change it. And I'm just going to call this F and F for short. So furniture and fixtures. And for right now, the balance is $34,800. And again, it's accumulated depreciation contra asset account goes wherever it goes. And right now, it's $29,870. $870. But we're pretty sure that number is going to change because we've got a month's worth of depreciation expense that will make that accumulated depreciation account increase. Okay, so let's be aware of that. Letter F, February 28th owner's equity is $26,700. Well, that's my beginning owner's equity. I'm looking for ending. This is the one I'm interested in because we're looking for March 31st. Okay, so we're given the beginning. Then we have March depreciation expense of $600. Well, there's that depreciation that we were talking about earlier. So I now need to add that to this number right here. So I'm going to go ahead and get rid of this number because we now know it's going to increase. And when you add that to the $29,870, we get $30,470 as our accumulated depreciation now. Also, since we've got an expense here, let's think about what's going to affect owner's equity. Remember, owner's equity is affected with net income, it's affected with a net loss, and the only way we can get that is with an income statement. So let's go ahead and create a quick income statement here because I have an expense, depreciation expense already of $600. I may have some more. I don't know yet, and that will give me my net income or loss, depending on which way it goes there. Okay, so we've taken care of this depreciation expense. Now in letter H, they tell me my cost of goods sold is 60% of sales. And that would tell me that gross profit then is 40% of sales because we know sales is 100% of itself. All right, so we're good with H. Other March expenses, including income tax, totaled $5,000 and they were paid in cash. Well, paid in cash means cash is going down, but we also have an additional expense there, which is going to increase my operating expenses. We may have some more, we don't know. Then they tell me in letter J, February 28th cash balance was $11,400. So that would have been my beginning cash balance, $11,400. Okay. And then March budgeted sales were $12,200. So I can put that in my income statement. Now I can calculate cost of goods sold. Cost of goods sold was 60% of sales. So when you multiply 12,200 times 60%, we get $7,320. And sales minus cost of goods sold is $4,880. And we need to keep going. We may have some other operating expenses, not sure yet. Letter L, March 31st. So again, that's the number we're looking for. Accounts receivable is 1/4 of March sales. So accounts receivable is 1/4 of March's sales, and March's sales were 12,200. Okay, so I'm getting that right here. March sales 12,200, and so that will give us a number 3,050. Okay, so L, we're good. And the last one, March cash receipts were 14,300. That's going to make my cash increase. So we don't have any more operating expenses. So operating expenses were 6,500. So it looks like operating expenses were greater than gross profit. So we're going to end up with a net loss of $720. That makes owner's equity decrease. So I'm going to put that here. So a net loss. If we had had a net income, we would put it on the credit side, making owner's equity increase. So keep that in mind as well. So now I can calculate the ending balance in cash and put that in my asset section. So if we take all of our debits for cash, 11,400 plus 14,300, and subtract my credits of $4,600, $8,200, and $5,000, we end up with an ending balance of $7,900. And owner's equity, we have a beginning balance of $26,700. Since it's a net loss, we'll subtract $720, and that will give us an ending balance in equity of $25,980, which will go into our owner's equity section of our balance sheet. And now we're going to simply add everything up. So when we add our assets up, you should get $30,280. And if you add liabilities of $4,300 plus $25,980, you should also get $30,280.